Monday morning, Brooke Sample wrote the following in Bloomberg Opinion. Though markets had a winning day Friday, overall, this year stocks have been tanking, interest rates and energy prices soaring, and recession fears mounting. Now, the red-hot housing market is cooling. In the UK, Canada, and US, would-be buyers are turning to rentals, pushing demand and rent, a key element of inflation, even higher. With mortgage rates north of 6% in the US, refinancing has screeched to a halt, leading to job cuts at some companies. Another wrinkle, a slowdown or correction in housing could create a ripple effect that would deepen any economic slump. It all feels a little bit like standing on a precipice. I'm Ben Reppond. Welcome to my YouTube broadcast. Today is June 28, 2022. A couple of subjects that I want to tackle. One is the housing market. I have been asked from previous videos, people commenting and asking questions about housing. Should I sell my house now? Or should I sell and rent? Or should I have some rentals? Should I sell them and whatever? People are thinking in this framework because there are people out there who are saying that the housing market is going to crash. So I did some research on the subject, and I want to cover that in a segment. I was looking for the perspective that the housing market is going to crash. Think 2008. Or the other side is the housing market is going to slow down, correct, pull back a little bit, flatten, soften, whatever you want to say, and then resume its upward trend. In other words, just it's a normal kind of correction. So I began to look for material and experts on both sides of that. What was interesting to me was that the only people I could find who were really saying, promoting the idea almost, that it's going to crash, were people who were doing podcasts and blogs and so forth, and not people of any reputation, and maybe they may be well-intended, but there was not really much credibility around the idea that we're headed into a real estate market crash. However, as I looked for material on a pullback, correction, softening of the real estate market, I found quite a bit of material. And so I wanted to play for you a couple of clips that I found on that. Following the material I'm going to cover on real estate, I'm also going to cover silver. Now, people have asked me also on silver, what do you recommend? Why silver versus gold? Should I buy paper, SLV, instead of the hard asset, and so forth? Various questions around, and why do you buy silver, and so forth. So I thought I would cover a segment on silver, and then I'm going to go extensively into the direction of the market, what's going on with the market, and in particular, Bloomberg did a segment. They took 150 years of data and looked at all of the periods of time where markets have actually corrected when we've gone into a recession. How did that go? How far down did the market go? And then they have sort of overlaid that or backfilled that with the current market and done an analysis, and they're going to present that. I'll show that to you. So thank you for watching. Let's dig into it. I want to show you, beginning with these two interviews. The first interview is Melissa Lee from CNBC, is interviewing Blackstone's Joe Zittel, and they're almost $1 trillion company and have a real estate division, and he is their chief investment strategist. And so, credible interview as far as what he sees from the Blackstone point of view, and if we have an economic recession, a downturn in the economy, what is the impact on real estate? So I'll play this now. This is Melissa Lee and Joe Zittel on CNBC.
Well, as consumers are getting squeezed, home prices apparently are still going through the roof. The St. Louis Fed reports the average U.S. home price in the first quarter was just over $500,000. That's a record. But one big player in the real estate market expects housing to hold up. Joe Zeidel is Blackstone's chief investment strategist. Joe, always great to see you. Where are we in the housing market at this point?
Well, thank you very much for having me. And I would say that there is very much the risk out there that conditions soften in the housing space, right? We've had this steady drumbeat of bad news over the last couple of months. Just over the course of the last few minutes, you've been talking about the rising mortgage rates and the consumers getting, pinched, as well as the negative wealth effect as people are looking at their statements or looking at their online brokerage accounts and seeing stocks down. And so you are hearing this drumbeat of bad news where, people are talking about recession odds rising over the next 12 months. But I'm of the view that there's a longer runway to the economic growth here in the United States. I think ultimately, the Fed is going to have to hike interest rates until something breaks. But I don't agree with the consensus view that says, recession, that we're on the edge of a recession now. I think that we've got a longer runway here, and it's household balance sheets that are really the source of that tailwind. So I do think that, over time, housing ends up, I think, having terrific supply and demand fundamentals so that when we do get to a point where something breaks, I don't think it's housing that does. This is not another setup to a 2007 or 2008 or 2009 type environment. I think there are risks out there in the economy, but in my opinion, housing is not one of those big risks.
It's sort of, though, mind-blowing, Joe, to think that mortgage rates can go up by this percentage in such a short amount of time without actually cooling the market down by just saying that it's supply-demand dynamics that will support everything. I mean, has there been an additional decrease in supply in the market? I mean, how do we think about this? It just doesn't make any logical sense on paper, at least to me, that you can have this spike in rates and you don't see that cool down.
Sure. I think there's a third dynamic to consider, right? One important consideration is going to be home price. Second is going to be mortgage rates. But the third is labor markets. And historically, housing ends up being more highly correlated to labor markets than it is to mortgage rates. And so what I would expect to see is that housing activity is going to slow down because of higher mortgage rates. But when you think about home prices, and if you think about the things that cause home prices to drop, that really ends up being a story of labor markets. As long as the jobs market remains relatively healthy, I think housing will as well. Now, we do have to think about how the jobs market overheating. Clearly that's something that the Fed is dealing with. So I do see some problems down the road. But again, this is not a next 6 months or next 12 months phenomenon. So I think we could see housing activity slow, and certainly we could see home price appreciation. I think that's got to have to level off. But if you think about the factors that are going to cause a drop in home prices, you really have to have, in my opinion, the unemployment rate rising. And I just don't see that anywhere in the next, 3 to 6 or 6 to 12 months. I think we're still in a relatively healthy jobs environment.
Next, I want to play a video from, this is on Bloomberg, same thing on the housing market, but it has a little more of an international tone to it. In other words, what is going on? What's their prediction of what's going to go on with the real estate market in the U.S. and compared to other countries, more of an international view on it. And so this will be an interplay, kind of not really an interview, but a conversation back and forth with John Ehrlichman, Krita Gupta, and Yelena Shaletyeva. Barely got that out. And so we'll play this and then I'll give you my comments.
Now you see the housing market slowing down because you see higher rates are having an effect. That should have an effect on housing prices, perhaps even fairly quickly, so that prices won't necessarily come down, but price increases will flatten out. We're seeing lower home sales, we're seeing lower starts, so we're seeing a slowing in housing.
This
This is Bloomberg Markets. I'm Kriti Gupta with John Ehrlichman. You were just listening to Fed Chair Jay Powell testifying earlier today before the Senate Banking Committee. And the U.S. isn't the only country seeing signs of a housing slowdown. At least that's the topic of today's Big Take. Joining us now to break it all down is Yelena Shaletova, senior U.S. economist for Bloomberg Economics. Yelena, thank you as always for joining us. This is a conversation we've had in the markets for some time now, being priced in. You also had a Bloomberg scoop, I should add, that hundreds are being cut or reassigned in JP Morgan's mortgage unit as housing demand begins slumping during this rate surge. So you can really see the effects across really all parts of both the market and the economy. But I have to ask, the faster the deceleration that you're seeing, what are the ripple effects that you're going to see across the U.S. economy in particular?
Well, I think the U.S. economy is pretty much insulated from a full-blown housing crisis akin to what we saw back in 2007. I think it's just the thing is that real estate, if you look at that, homeowners' equity in real estate is at the highest level since 1980s. You look at debt service ratios, they're at the lowest levels. So the households have delevered quite a lot. So the risks to the financial system from the housing market are pretty low at this point. Of course, housing will slow down and it will have some spillover effects on consumption and so on. But that's the whole idea of slowing demand by raising interest rates, as Chair Powell mentioned today.
Yelena, interesting to hear you say that, echoing some of what we just heard from Megan Green of Harvard as we look at some of these bubbliest housing markets around the world based on the economics work that Bloomberg has done, whether it's New Zealand or Australia or here in Canada, where over the last couple of years, it has not been surprising in some home markets to see prices increase by more than 50%. You know, there was a trend that started going back to the financial crisis where more conservative Canadians who managed on the economic front and then saw record low interest rates for basically a decade started to get in. So could we be in a situation where the U.S. navigates relatively well, but has to be keeping an eye on these global housing markets because of this uncertainty?
Absolutely. I think, yes, you're right. Canada is among those countries that potentially see the highest risks, according to the analysis that was performed by my colleague Niraj Shah at Bloomberg Economics. I think the U.S. is relatively safe in this environment. And again, because I think the U.S. consumer has delivered quite a bit relative to what we saw back in the early 2000s. So I think that is a really important distinction here. Also, the U.S. consumer has accumulated a lot of savings, and those excess savings will provide some cushion despite the fact that the savings rate in the U.S. has fallen quite a bit since the peak we saw back during the crisis.
So what I think they're saying here is that the housing market in the U.S., their opinion is that if we hit a recessionary period, which we are basically in right now, we'll get confirmation of that in the coming weeks when the CPI report comes out for the month of June. But we're in a recession, so what's the housing market going to look like? The reason this is of concern to people is because prices are so elevated. They use the term, I've never heard this before, bubblish, bubbliest. Which are the bubbliest countries? They all feel kind of bubbly. And we're focused on the U.S. What is going to happen here in this very elevated price? It seems like it's all set up to collapse. And what they're saying is a flattening, a softening, some kind of pullback, but not a crash. And the reasons are multiple, which they articulated, meaning a lot of equity is already in homes. And they didn't say it, but I know that a lot of people own their homes outright and have paid off their mortgages or paid for them with cash. And people are sitting on low interest loans, fixed rate loans. Very few people have adjustable rate mortgages. And those that have homes, many of them have a lot of equity. So if prices come down, they're not underwater. They are there's still equity in their homes. Maybe they temporarily lost some, but people have to live somewhere, and they just choose not to sell their house. And that seems like the likely scenario. I think of it in terms of like a practical term. So for example, if you buy a home, and let's just say it costs $500,000, you pay $500,000 for a house, and we hit a flattening of the market, instead of you being able to sell it for higher and higher prices with multiple offers, maybe the price comes down to say $450,000, and you may have to wait for a few months, and there's one offer, not five, and that person may need a mortgage instead of having all cash, etc. So that's what I interpret as a softening of the real estate market. So very different than the stock market and the bond market. The stock market and the bond market may in fact completely collapse, and the real estate market fairly well hold up during that period of time. Not enough of a pullback or a decline to maybe justify selling and renting and then rebuying, etc. There are a few charts I wanted to show you regarding the real estate market. One is the U.S. existing home sales, and this is a chart, a lot of squiggly lines, but a chart showing the past 8 years. The dark blue line is 2022, so you can see the home sales relative to this year, relative to previous years. And what's interesting is, of those 7 years, six of them are equal to or greater than the current market. So in other words, the home sales have slowed down a bit relative to previous years and relative to where we are in the annual cycle. Only 1 year, and that was 2020, probably due to the pandemic, would be lower than the current year. So when they're talking about a softening of the real estate market, real estate sales, this would be a chart that would bear that out. This chart shows the home inventory. So if sales come down, inventory or the days on the market tends to go up. So again, interesting, of the past 7 years, that all of them have higher levels of inventory than the current year. So it's still a low inventory market in general in the U.S. Itself. However, you can see this blue line is moving up very quickly, which is showing that inventory is starting to build, and there's becoming a little bit, I won't say excess, but there's a little bit more inventory in the market. This chart shows it says unprecedented surge in home buyer mortgage payments. So it tracks, this is from Redfin, tracks the mortgage payments on average in the U.S. going back to 2015, and then shows the current year. So for a variety of reasons, increasing interest rates probably, price of home sales for sure, the payments that people are making, those who have mortgages, relative to previous years, much, much higher. This is not sustainable, so that will probably be an area that will have some kind of correction to it. 6% of the listings had price drops this year compared to the previous 2 years where there was very little price reductions. So again, another indicator, softening of the real estate market. Not collapsing, but definitely softening. When looking at the single-family homes that are attached to each other, not condos, but multiple dwellings attached to each other with a common wall, and detached, meaning single-family residences, the rental price growth has accelerated a lot. This is tied to the home sales, lack of inventory, prices, et cetera. People are looking to the rental market as an alternative, but again, that is, prices are escalating or have escalated in that market as well. Do you remember back in December 2021, so this is about 6 months ago, do you remember Chairman Powell saying inflation is transitory? Remember that word? Inflation is transitory. Did you think to yourself, I don't think that's right. That doesn't sound right to me. Well, that's what I was thinking, and I suspect maybe others were thinking the same thing, that that's not very credible. I think we're smarter than that, and I know he's smarter than that. And then a few months ago, I believe it was in March, he was talking about the concept of he was going to raise interest rates, the Federal Reserve raise interest rates, and that the result was going to be a soft landing for the economy. In other words, now think about this. The inflation's going out of control. It was in full force at that time. We're going to raise interest rates just enough to bring inflation down, and it's not going to hurt the economy. Everybody's going to be okay. That just doesn't make sense. So there was 2 times, one in December, one in March, where he was trying to sell the idea, I don't know what he thinks our intelligence level is here, but that just didn't fly. And now he's saying higher interest rates could cause a recession. Really? Of course they will. I'm going to show you a slide next, and you'll see how far behind they are in raising interest rates. If inflation keeps going, they're going to have to raise rates faster and at a higher level to knock out inflation, and they have to do that because out of control inflation is not an option for them or for us. This is what I'm referring to. This is an overlay chart. Each color represents a different period of time, going back to 1988, when the Federal Reserve raised interest rates. Probably not inflation, but maybe it was an overheated economy, maybe a little bit, nothing like today. You'd have to go back to the 1970s or at least to 1980 to find a period of time that is the kind of inflation we're dealing with now. But in all of these periods of time, there were 4 times from 1988 to present where they raised rates from the beginning until today at a rate faster than the Federal Reserve has now raised rates. Only one time, the line at the bottom, only one time did they raise rates slower than today. And yet these periods were not periods of high inflation. So here we are, here the Federal Reserve is trying to deal with inflation, really almost out of control inflation, and the response is the gray line, which is tepid. That's the only word I can think of. It is anemic for what the kind of inflation that we're experiencing. We are clearly being compared to the 1970s, where there was almost out of control inflation, and the Federal Reserve is not responding in a way that's going to deal with it. So again, I normally try to stay away from predictions, but I'm going to predict this, that the Federal Reserve is going to get themselves further in a box, and they're going to have to raise rates frequently and aggressively at some point. This tiptoeing into this, as you can see from the gray line, is not going to be enough. Moving over to credit cards, there are a lot of people who have credit card debt, and that is not a good thing. So if you have credit card debt, that's consumer debt, I recommend, if at all possible, you find a way to pay off that debt, because you are not going to get ahead paying interest on credit card debt. Now, look at where interest rates have gone on credit cards. Now they are in the 20% range. So you're paying 20% to the credit card company for outstanding balances. So if you have a credit card, I do, most people do, pay it off. Pay it off at the end of each month. Do not carry a balance. You're not going to get ahead paying 20% interest to the credit card company. I mentioned that we are, I've talked about in silver and buying silver. I buy silver, and I recommend that. Now, people have questioned me a lot on this. Why do you buy it? Why not gold? Why silver? What's the big deal about silver or gold? Okay, so I'm going to cover a little segment about why I do this. My thinking, I've read several books on it, and I've listened to a lot of interviews with Jim Rickards, Jim Rogers, David McElvaney, others. And you know, my thinking has been influenced by those people. I buy silver as not as an investment, as an insurance policy against the decline, the declining value of the dollar. We know the dollar is being eroded in value with inflation. And there's always inflation that's going on most of the time. And so the erosion happens very gradually. Now, because inflation is going so rapidly upward, the erosion is happening faster. So if as we have erosion, or if we get to the point where the dollar is worth very little or worth nothing, or the dollar is removed as a means of currency, of transacting business, a medium of exchange, that's why I have silver, is a backup plan, a plan B, if that were to happen. I do not care if the price of silver goes up today, this week, this month, up or down, it doesn't matter to me at all, because that's not why I have it. I have it because if we get to that point, I will be glad I've got some. It has been a store of value for 5,000 years. It has kept up with the rate of inflation approximately over a long, long period of time, while in fact, the paper currencies, like the dollar and others, have declined in value, and many of them have gone out of existence. But silver and gold have not gone out of existence. I look at it as a means of bartering, if we need to do that. Now that's a harsh term, and I hope that we don't get to bartering, but if we live in crazy times. So if we were to get to a point where the dollar is not accepted, or the dollar is replaced with something else, or we're completely in a digital mode and locked out of our banks, this has happened and is actually happening now. And you know, could that happen in the U.S.? It could. So if we're in a mode of bartering, then I want something which is a small unit value item, which is generally accepted, and that would be silver. I don't want to go into the grocery store with an ounce of gold to get my groceries. That's an expensive item. So it makes it easier to work with, to have a smaller unit, so that I can transact business on a day-to-day basis with smaller items. Gold or silver, which one is best? Well, they're both good. So I would not say that silver is completely the only way to go, because gold has value and does approximately the same thing, except for the bartering comment that I just made. There is a ratio when you take the value of gold, numerator, divided by the value of silver, that develops a ratio. That current ratio is about 88 to 1. The historic mean is 31 to 1. So right now we are at a high number relative to historic norms. So what that means is that silver today is a better value in buying it than gold. Doesn't mean somebody that wants to buy gold, it's a bad thing, not at all. It's a good thing if that's what your goal is. but it does mean people pay attention to that silver gold ratio, and when it's in this range, call it 88 to 1, it makes silver, the case for silver, buying of silver. Warren Buffett owns 129 million ounces of silver. That is not my number one reason for buying it, but I thought it's an interesting fact, and I have a lot of respect for Warren Buffett, so that tells me a lot right there. Silver also has an industrial application. It's a conductor of electricity, so it's used in electronics. Of course, it's also used in jewelry. So there's intrinsic value that because it is used in other types of applications, none of that is going away. So if you don't have silver and you think, well, I didn't really wake up this morning thinking I was going to buy silver, and I've really got all of my money committed to this or that, what should I do? So my thought is, if you don't have any silver and you don't have some money laying around to buy silver with, do what you can. Buy something. It cost the spot silver, the intrinsic value of silver is about $21 an ounce. There's a markup on top of that for retail, and let's just say that's $5 approximately. That's $26 per coin. So that would be, if you got a little case of them, a container of them, that would be a little over $500 for 20. And that's silver bullion. So if you bought one of those, a little over $500, that's a place to start. Or you could say, take 1% of your liquid net worth and say, I want to do this until I get to 1%. When you get to 1, go to 2, etc. Jim Rickards, in his book, The Death of Money, says 15%. Again, just a benchmark, not that you have to do it, but that would be, give you some kind of idea on how to begin to buy and accumulate silver. There are issues around storage. I do not store my silver in the house. So, and by the way, I have physical cash. I've talked about that too, that I've taken out in 20s, and I do not store that in my house. So and I also don't store them in the bank. So that leaves a lot of room for other places you can store them. I'm not going to go into that because that's up to you. And I don't store them in the house for security reasons, and I don't want to be a target, so that's the way I do it. So you can think of other options that are available to you, and then with silver, I mean, there's if you buy a significant amount, you get into a storage issue with, it's quite takes up a lot of space and it's weighty. Where do I store that? Well, I've given you a range of options of what I don't do. Everything else is somewhere in the middle. So hopefully that's helpful on silver. And if you have questions, feel free to reach out. I'm going to get into the stock market, and these are some assets, asset classes or stocks, and we'll take a look at these. So we are in this video I'm going to show you in just a minute. You'll see we are clearly in a bear market. We are not yet officially in the recession, although I would say we probably are. We'll know very shortly if it's official or not. But we're in a bear market. The market is coming down. Now, what happens when the stock market comes down, or for that matter, the bond market comes down? If we are in a long-term decline, it doesn't mean that every day or every week, every month, there is a continual decline. The way it works is there's a decline and it went further than people thought, and then traders come in and push it back up a little bit, and then it collapses again. Now, those don't happen evenly. They happen very unevenly. So you will see last Friday was a very positive day for the stock market. So even though it was positive, that does not mean that we are headed in an upward direction. The general direction of the market is down. However, when we have these little periods of time, could be a few days, could even be a few weeks, a month or more, those are called bear market rallies. And every bear market has them because it tries to go back up, becomes a trading opportunity for short-term traders. But for people who are really looking at the longer-term trend, usually they don't bite on it. So, and we manage money carefully, and we will come back into the market very carefully when it is appropriate to do so. But a quick move up, having a good week last week or a good day on Friday is not temptation to jump back into the market. So in the far right column, I wanted to show this. These are the percentage decline of the various indexes from the beginning of the year. So the Dow down 13%, S&P 500 down 18%. Bonds, the 20-year, and I put a yellow bracket on it, the 20-year long-term government bond that is supposed to be the protection for stocks. As these stocks are declining, bonds are supposed to go up, right? The long-term government bond, exchange traded fund, TLT, down 24%, worse than the S&P and the Dow. Not good. An indicator that the traditional portfolios that people have, traditional brokerage accounts, IRAs that people have, are getting decimated. They're decimated because stocks are going down, but in many cases because stocks and bonds are going down. And the traditional financial advisors, I covered this last week, they don't have an answer for it. Their answers are weak, and they say, you know, stay in your seat, don't sell now, you got to invest for the long run. I've talked to a number of people who have talked to their financial advisors, and they have said that some of them literally told me that their financial advisor said, I know you're telling me to sell, I'm not going to sell it. It's not the right thing to do, you should stay invested. These people also said, I told my financial advisor in January to sell everything, in February, and they recount to me the amount, the tens of thousands or hundreds of thousands of dollars that they have lost in that period of time because their financial advisor was convinced that it's going to go on back up. Well, it didn't go back up. And by the way, what's worse, bonds did not save the day. So people are upset, they're very angry, and they're looking at their portfolios saying, this is not good, and they don't know what to do. So that third line on Treasury bonds is a significant item on this chart. And then you go on down to the NASDAQ 100, down 26%, the technology component of the NASDAQ 100 down 30%, the ARK-K Innovation Fund down 51, and Netflix down 68. So the next chart shows different asset classes and different indexes from a dashboard perspective. I'm showing the red dot on 4 different columns. They are the 20, 50, 100, and 200-day moving averages for each of these indexes. In every case, the index is below its moving average except for 2 instances. So there are 10 ETFs, 10 of them, and 4 moving averages for each one. So that's 40 moving averages in total. 2 out of 40 are positive. That is not an indication we are in an up market. So the best performer is GLD, representing gold. The next best, and that's down 0.5%. Next best is SLV for silver, down 9%. And then we go into the Dow, DIA, EEM, which is emerging markets, S&P 500 SPY, we've already covered that, down about 18%. EFA, which is the developed countries, down 19%. The Russell 2000 small cap index down 21. NASDAQ 100, we've covered that, down 26. Netflix down 68, and Coinbase down 75. So very bearish looking dashboard. Then we look at the sectors within the S&P 500. The sectors are, for example, retail, financials, technology, utilities, etc. All of these are the component parts of the S&P 500. Same thing, 20, 50, 100, and 200-day moving averages broken down by sector. And so here we have 6 sectors that have at least 1 green dot. Matter of fact, none have even 2 green dots. And there are 11 sectors, 4 moving averages. That's 44 opportunities for green dots. There are 6. Again, when you break the S&P apart, it tells you that while there are some that are starting to emerge a little bit on a short-term basis, are they going to be there long-term? We don't have any indication from this chart that that's going to be the case. So again, a bearish-looking chart. I want to play this video for you. It's very brief. It's about a minute. And it is Danny Berger from Bloomberg. And she is explaining that Bloomberg, believes that stocks have a lot further to fall than they have already before they hit a bottom. And what they've done, what Bloomberg has done, is they've gone back and looked at 150 years of historical data during recessions to see what is the behavior that stocks typically have during periods like that, and then kind of transpose that over on top of what we have in 2022. And I'll let her explain what they see as far as the future of the stock market. Now, this is an estimation, so there's no guarantee of this, but it has some degree of credibility to it. And here is Danny Berger.
The S&P 500 index may have another 24% to fall by year-end. That's according to SocGen, based on the past 150 years of financial market history, they say. Bloomberg's Danny Berger has been poring over the details. Danny.
Yeah, Anna, this comes from the quant team, and you know I love me some quants. It's an interesting argument and thesis to hear, especially today on a day when stocks are rallying, perhaps due to the concern about the economy and what that means for the Fed. But basically, looking at this wide set of data, they argue that from the peaks, the fair valuation of when we enter into a crisis period and come out of it is far lower than where we are now. Indeed, they say that from the January peak, we needed to fall about 40%. In percentage point terms, we're about halfway there. So it's not necessarily about valuations of this market. It's based on past crises valuations as well. And look, part of the conversation is perhaps we haven't fully capitulated, and that's why we're not as low as where SocGen thinks we will be. Perhaps we'll get there. There are signs of pessimism. For example, Bank of America says that through Wednesday, there were outflows from equity funds the most in 9 weeks. So there certainly are concerns there. But again, that came before markets started to rebound. So how much further do they need to go to fit, in the opinion of SocGen, that sort of post-crisis valuation?
Okay, we'll go into some charts now. From perspective of looking at the last year or so. And at the beginning, I want to look at the S&P 500. It's a good place to start. We look at the last year, and this is a weekly chart, meaning one move equals 1 week for the past 12 months. And I put some things on here to make note of. You can see that up until toward the end of last year, in December, that the S&P was generally speaking moving in an upward direction. Then the S&P started moving in a downward direction in late December and has continued down. It's gone up and down, but continues in a general downward direction. There are 3 times during the past 6 months in 2022, and I circled those in black So you could see there are times where the S&P tried to go up and then it collapsed. And that is what I was talking about earlier. This is typical of a bear market. The bear market is a general downward direction, and there are times where it tries to go back up. Each one a little different, but in a sense, they all kind of look the same. So I expect that until we break out of the bear market. But as I look out into the future, I see nothing but headwinds. So the economy and the stock market are two different things. They will go in sometimes in different directions for different reasons. So I don't want to say they're the same. But when I look at the economic headwinds, I think of things like, okay, rapidly rising interest rates, rapidly rising inflation, a falling stock market, a falling bond market, a softening in the housing market, a tight labor market, and just numerous issues, supply chain issues, and agricultural issues, food issues, all energy prices, all kinds of issues that are facing us, and there does not appear to be a resolution in sight on any one of these fronts. And what the market is going to eventually need, what investors are going to eventually need, is some kind of light at the end of the tunnel that says they may not be better today, but they are going to be better. And once the market sees that, it will then respond in a positive way to that. This is a comparison chart, or a relative strength chart. So this compares uses the growth stocks called SPY-G as the numerator, SPY-V value stocks as the denominator, and plots that ratio. When growth stocks are moving up at a faster rate or falling at a slower rate than value stocks, then it will move in an upward direction. When value stocks are moving up at a faster rate or falling at a slower rate than growth stocks, it will move in a downward direction. So what you see is, and this is a 12-month chart, you can see about 8 or 9 months where it moved generally in an upward direction, meaning growth stocks were in favor, and then generally moved in a downward direction, meaning value stocks were in favor. They were both falling during the past 6 or 7 months, but falling at maybe 8 months, but value stocks were falling less. At the very end of the chart, I put a little black circle to show this past week or two. So you can see that growth, it looks like, may start to come back into favor. We don't know if that's a head fake or if that's a trend, the beginning of a trend, but I thought I would make note of that. When we do the same thing, 12-month chart, weekly chart, with the small cap index, the Russell 2000, IWM is the ticker, as a numerator, S&P 500 SPY, as a denominator, that we plot that ratio, and we can see that the general direction of small cap is down. So when it's moving down, that means small cap is falling at a faster rate or going up at a slower rate than the S&P 500. And so here we have an entire year where the S&P, then small cap index, moved less favorably than the S&P 500. I go from a 12-month chart to a 24-month chart. So we're back to TLT, which is the long-term government bond ETF. And I plot it not in a relationship to another stock or ETF, but by itself. So you can see the movement of the long-term government bond over a 24-month period. So you can see on the left side of the chart, the red arrow shows that long period of time where the long-term government bond came down. And then it had a little bit of a rally for a period of time. And then beginning in late last year, late November, it began its downward decline and actual collapse. And remember in that previous chart I said that this exchange traded fund has dropped 24% since January 1. And from its top, even more. So things are changing. What's causing this? Interest rates are going up. And if interest rates go up, bond yields go up. And if bond yields go up, the price of bonds collapses. And interest rates are going up to counter inflation. And it does not appear that that is slowing down. So I don't see a slowdown to rising interest rates, at least at this time. And therefore, I don't see any relief for bond yields, that they will continue to rise as interest rates go up. And of course, bond prices and investor portfolios are continuing to decline, this being one of the major culprits. Gold, represented by the ETF GLD, this is a 24-month chart, and it just goes up and down a lot. I mean, there are times where gold trends up, there's times where gold trends down. But for the past 24 months, there is really not a trend. It's a lot of up and down. We get to silver. Silver is also a lot of up and down, but for the last, 13 months or so, silver has generally been more in a declining period. And remember, I talked earlier about this gold-silver ratio being 88-1, making silver more in favor right now as a value relative to gold. This would contribute to that. When I plot the two on a ratio, plot that ratio, it looks like this. So you can see for a period of time, silver was way outperforming gold. And then for a longer period of time, represented by the black arrow, gold has outperformed silver, which means it is a downward sloping line. I show the volatility index, and it has generally been in an uptrending mode. Now, what that means is that there is increasing volatility in the market. And the arbitrary red line at the right is the number 24. It's generally thought that if the volatility index is moving in a downward direction below 24, that is favorable for equity markets. It is now at, as of Friday, it was at 27. So it is still in a more volatile state, even after a favorable week last week. Asbury Research does indicators. These are 6 of their indicators showing that the market is still generally negative. A couple of them have turned positive, but 4 are negative. They do a relative performance of different assets or asset types, and showing the weekly, the monthly, and the quarterly direction, and comparing. Only one is favorable, enough favorable to get a green box in all 3 categories. So, and that is the United States versus developed markets. And so the United States is moving ahead. U.S. has not been very strong in the last year, but here we start to see a little bit of emerging favoring the U.S. markets. This says the same thing. This is comparing the U.S. versus the world. So there are a lot of countries listed here. I believe there's 21, and certain regions of the world. And the U.S. is listed in a lot of them as being more favorable. However, not a single one is the U.S. strong enough to get a green box. So it's slightly favorable to the U.S. in many cases, but not enough for that. And there's none of them that are favorable enough in all three categories. What's interesting is take note of the countries that have outperformed the U.S. During the last month and the last quarter. Hong Kong, Singapore, China, Russia, and emerging markets. I want to give you the score on gold and silver. As of June 25th, gold was down about 0.8% for the past week, silver down about 2.5% for the past week, and then I give you some resources that I've used for checking prices and spot price. This doesn't relate to anything, but I saw it. I thought it was interesting, so I thought I would share it at the end of the video. This talks about where do we get our information from? Podcasts. There is an increasing amount of people who are getting their information, I don't know if it's news or otherwise, but information from podcasts. They rank this by country. And so the countries that have get their information most from podcasts are Sweden and Spain. Right next to that are the US and Canada, and then it falls off to France, Germany, Japan, United Kingdom. And all cases, the current rate of information obtained from podcast is greater than it was in all countries 3 years ago. Interesting. I think that's self-explanatory. I want to thank you for watching. Thank you for liking and sharing and subscribing to my channel. I want to tell you that I have been blown away by the reception that I've gotten, by the number of views that I've gotten, and that's because of you. Thank you for doing that. I had no idea that my message would resonate with so many people. I started doing YouTube on January 18th this year, 2022. Prior to that, I was doing webinars, and they were a very small audience and limited. And then I decided to go on a more open platform using YouTube to be able to really get my message out to a broader audience, more on a public platform. And so I went back this morning, and I looked at the number of views that I had on that very first YouTube video on January 18th. I had 213. I don't remember exactly the number of subscribers, but I'll say it was 50. It was something like that. Maybe 50 subscribers and 200 views. I was so fortunate, thanks to YouTube and thanks to you, that a month ago, the video I did a month ago shot up, and it was increasing views, and all of a sudden it exploded. And that video on March 31st has now over 400,000 views. And it is still increasing at the rate of over 10,000 a day. I am blown away by this, but and the subscribers are nearly about 9,000 subscribers now. So I want to thank you for that. But the thing that has blown me away more than those numbers has been the comments. My message is an alternative message. It's not mainstream. This is not the typical financial advisor chatter. You're not going to hear the same old, same old. It's different. I know that. I expected that, but I had no idea that it would resonate with so many people, and so many people were looking for what I have to say. So thank you to those of you who've given me encouraging words, and I'm going to continue. The other thing I try to do, that I do, is I do not accept ads. So they do put an ad at the beginning of it, and YouTube keeps that revenue. but I don't share in any revenue for ads because ads annoy me, and I assume they must annoy you, so I don't do that. But so I try to keep it just pure information and educational. And there are people, I do make money from advising people on their investments, and there are people who have reached out, and I appreciate that, who've said, you know, I want you to manage my money. I like the way you think. Well, I appreciate that. But I don't use the platform as a way to solicit. It's more pure information. And so again, thank you for the generous comments. They've been very encouraging, and I wasn't going to stop anyway, but if I were ever inclined to, I wouldn't do it. So thank you very much, and thanks for watching.